Well, hey guys, welcome to another week of Brett's Property Rants. And actually today's a pretty cool day because actually, debt tsunami or kicking the can down the road. I think this is one of the, it's the eternal debate. Is it this or that? And I think, there's no real clear answer and nobody can give you a definitive answer, but it is very polarizing, and I think, to be fair, you'll see, as I explained throughout today, where I sit on that. And I think if you've been watching me for a while, you'll see why I'm actually, one side, not the other. But we're also going to cover the housing market potentially goes off with a bang in 2021. There's just still that momentum and still that, people out there buying and using the stamp duty and using the, the pent up demand, which is great. Halifax house prices, their report, we'll have a look at that. You've got Brexit, still a deal on the table. We'll see. 100 billion to spend. Apparently everybody has 100 billion to spend. That's savings over COVID time, which is incredible. Emerging markets. We'll look at the debts and what's likely to happen with that. And then reflation. You may not have heard this word before, but it's something that happens after recession. So we'll have a quick look at that. And then new types of credit management, because I think there's going to be winners and losers. Okay. And the real problem is what happens with the losers. Okay. And then we'll have a look at major city centres, but Birmingham in particular. And guys, this is the last week. Next week is my last week, sorry. So next week we're going to be looking at Liverpool actually as a city. We've sort of been covering each of them as we go through. But anyway, let's get onto it. So before we get started, guys, if you can, please click the like button, click the subscribe button, and we've got the comments there. So if you've got any questions whatsoever, if you want to make any comments, jump in and please ask them. But make sure you subscribe and like, because that way you'll get reminders and the team will appreciate that. All right, so let's jump in. So property market expected to start 2021 with a bang. Pent up demand, COVID, all those sort of things. I remember in October I was saying things will start to slow down now, and then it didn't happen, and then November didn't happen, and now it's December and it's still going. It's still going, which, is fantastic. I mean, it's fantastic news for the property market. I know there's a lot of first-time buyers saying we can't get on the market, and we're going and competing and we're losing out every single time. And I mean, that is unfortunately the nature of the marketplace that we're in. Will it slow down? Will they extend it? I know there's a lot of industry bodies saying, get rid of stamp duty altogether. Look, I'm a big believer stamp duty is a killer, and it actually doesn't raise that much money for the government. If anything, it stifles the buying and selling of property. Maybe they increase capital gains tax, get rid of stamp duty. I don't know. But a thriving market that you can buy and sell really easy without all these taxation restrictions is a good thing. But yeah, on top of this, we've got the strongest gains, 5 monthly gains since 2004. Now this is the Halifax report that's come out. Now, interestingly, this is since 2004, the 5 monthly gains, okay? And it's saying 6.5%. But then if we go to the next step, which is the same report, it's basically saying 7.6% higher than the same month a year earlier, yeah? Which is pretty dramatic. And if you have a look there, come June, end of lockdown, boom, things really started to take off. Now, I mean, guys, write your comments and feel, what are you guys thinking? Do you guys agree that house prices? Because it's interesting from what I'm getting, the feedback and the notes and that sort of thing is that actually it's very much still a two-tier economy. There's places that are doing really well and places that are still not really doing that fantastic, and maybe this is where that £100 billion of levelling up money will bring relief to those places which just haven't had anything happening to them for too long now. Yeah. So normally I'll leave Brexit to the end, but actually it's getting quite exciting now with the whole Brexit thing. So look, as Brexit talks stall, Boris Johnson offers the EU an olive branch. Now, interestingly, what he does, and the next thing was, compromise appears off the menu for Johnson's Brussels dinner date. But in actual fact, he did compromise. He's dropped the threat of breaking international law. And this is the interesting thing. He's got this, this dinner on Wednesday night, which is tonight, actually. So the reality is we'll see what happens. I'm not sure they'll get a deal tonight, but I think it'll be coming. I still believe there'll be a deal. I think politically, it's just not that palatable not to have some form of a deal, okay? And I think, to be fair, they can't really kick it down the road, the can down the road for this one, because there's so much political, behind it. So I still think there'll be one. I think it'll be the last minute, the last hour, as I've said many times before. And actually that's a good thing. As we've seen, Brexit the whole way through has been predicted to be terrible, and it's never actually really come out that terrible. Okay, house prices could have dropped. I think it was 18% was predicted. That never happened. And there's so many instances of where this is going to happen, this is going to happen, this is going to happen. Now look, yes, we will take a kick in the teeth with a GDP. They say 1 to 3% depending on who you believe. But I would say that's probably already happened, and our currency probably already happened. So a lot of and sure, there'll be some confusion, when the changeover happens. That is going to happen, but that will probably sort itself out relatively quickly. So yeah, we'll hold out for that. But it certainly seems like the whole let's break international laws and the Internal Markets Act and things like that were more of a negotiating tactic than necessarily about, real life of what they wanted. We'll see. I may be wrong, so. All right, so locked down shoppers have £100 billion to spend. Yeah, so congratulations, guys. I've got to give you a clap, because we've all saved £100 billion over lockdown. It's an incredible number when you think about it. The question is what do we do with that now? If we go out and spend it, we can see recovery happening, pretty quickly. And I think that really is the important thing. So my question to you guys, and type it in the comments, guys, are you going to go out and spend your share? Have you actually, saved money while you've been away? I know a lot of people I chat to have, absolutely, because they haven't been going out and spending and all that sort of stuff. Although what I've started to hear is a lot more purchases as people have moved online and really got used to shopping online. Whereas before they'd go out, now they're not going out. So, but there's still a lot of savings, and actually we've had a lot of people that I know buy houses. So, good news from that perspective. All right, so yeah, guys. So debt tsunamis. Oof, so this is the sort of major chat for today. Look, I think with this whole one, we've got to. The numbers are so big, it's hard to fathom them. Yeah, and they're massive. Okay, when you consider them as an individual, but as a world and as a country, they are still big. But they're not impossible, and I'll explain why and what the distinction I think is around this. So let's have a look. So pandemic fuels global debt tsunami. Now, the assumption in that and the inference in that is that we've got this tsunami coming that's going to hit us real hard. Lots of people saying in 2021, and it's all around this. Governments and companies took 15 trillion more borrowing in the first 9 months. And the IIF is the International Institute of International Finance. If you have a look at this, global debt levels have soared during the pandemic. Yeah. Now this is debt to GDP, so we're talking 320%. This is worldwide. Okay, has gone up to 360 plus. Yeah. So that's a pretty hefty jump. Total level of debt indebtedness has increased 15 trillion. Leaving 270. We're on track for this year, 277. Yeah, that's pretty full on. Yeah, and the total debt expects to reach 365. Yeah, by the end of the year, surging. So from 320 to 365. Now, if you have a look at this, what the prediction is that will go to 300. Now, don't get confused. There's 365% of GDP, but the actual debt is 360 trillion by 2030. Yeah. The positive thing is, if you have a look there, that consumer or household debt is not necessarily going to jump that much. The general government debt is where the big one is, the non-financial corporates. Okay. So, finance sector, those sort of things. So, this is interesting because I think, there's no doubt the economy now, we used to have a gold standard, we got rid of it. Yeah. And now we're in a fiat currency. Yeah. So a lot of people say, oh, fiat currencies don't work and this has to happen and, debt bubbles and they have to deflate and all this sort of stuff. And there is an element in that, and there is a total argument for that, and I get that argument. Yeah. But I also think I've been getting this argument for 25 years and it still hasn't happened because we keep inflating the economy. Yeah. And it appears that we may well continue doing that and get away with it. Now, the question is, have we inflated too quickly too much to actually rein it back in, and therefore we are going to fall over and bubble? And I think that's the real thing. Guys, give me your thoughts in the comments. I'd love to, have a bit of a discussion about that and see what your thoughts are, because obviously, with my economics training and that sort of thing, at the end of the day, I sort of look at things and then I look at the other side of the coin and I sort of weigh up the things. And I think either way, you've got to look at sort of the two sides and make a decision and decide where you're going to be. And for me, where I think is that actually we are kicking the can down the road. I don't see this big debt bubble that's going to bust in 2021. Okay, now it could, and I know a lot of people are predicting it, and I know a lot of people are, but to be fair, most economists now are not predicting that. Most, the major, things are not predicting the bubble bursting. Yeah. So, the question is what's going to happen, and will there be a bubble burst? And I think this is the next step of the question, which is, if you look at emerging markets, debt burdens are especially onerous on emerging markets. Yeah, having risen 26% or percentage points so far this year. Yeah, to approach 250% GDP, which is quite high. Look, I think the thing here with the emerging markets is, we're talking about, and it depends where we're talking. There's European emerging markets like Poland and some of those eastern sort of European countries that are trying to get into the EU and things like that. But there's also the Africas, and there's that are naturally indebted. But there's also places like that are in the GDP, Italy, for instance. So there's those sort of ones. But look, if we look at sovereign debts, this week Zambia become the 6th developed country, and I think actually that might have been last week. But yeah, more defaults are expected. Ecuador, Argentina, Lebanon are among those with high probabilities. Sovereign default risks will rise further in 2021. You're talking about Iraq, Sri Lanka, Angola, Gabon. So a lot of these places, Belarus, Mozambique, Mongolia, there's no major countries there. Pakistan, El Salvador. So the thing with this is that, a lot of these emerging markets, the problem with them, and the way I see this is this, and this is sort of summed up here. That's what the debt tsunami looks like. Now, this is the figures for emerging markets, yeah? 7 trillion of emerging market debt will come due by the end of 2021, yeah, including short-term COVID-related borrowing. Now, that there is a major issue for the emerging markets, because if they can't refinance that debt, they're not going to be able to pay it back, and therefore they're likely to default. Now, if we have a look there, this is one of the issues, the debt service costs, because it's not necessarily about the debt, it's about the debt service costs, okay? So if we have a look here, you see that blue line is the emerging markets, where their costs are going up to service it towards the 10 mark, yeah? And yet the advanced economies is coming down, which means their debt load or their debt repayment load, yeah, is getting, the emerging markets is going up, the advanced economies is coming down. And this is what I've been saying is, even though we've borrowed so much money, if the servicing is very cheap, which it is, and the servicing is very likely to stay cheap for a longer period, which it is. So the reality with that is that, that's why I think, okay, debt tsunami, yes. And I think certainly with the developed countries, and this is, we talk about in all recessions, winners and losers. And I think there's winners and losers in everything. And I think when you look at hospitality and when you look at some of these, markets, there is a real thing where it's like, okay, you know what, they're probably going to lose. I mean, it's interesting. They have a thing, Maastricht criteria capping debt, blah, blah, blah. But it's basically what he said, or what the criteria is 3% deficit. So a government should run at 3% deficit or 60% debt to GDP. And this is actually what they use for EU membership, But what you're finding, most economists are saying, forget the deficit for now, spend your way out of this pandemic. And I think that is the overriding approach for all governments across the world, yeah? And it kind of has to be. The real tsunami will be if these emerging markets start to default and fall over, and then the debt starts getting more expensive for those countries. So, they may be the losers in this, Yeah. Now, there is a new term that you probably haven't heard of very much, but it's reflation. And this is where we use fiscal and monetary policy effectively to stimulate the economy out of recession. So the recession comes, the market drops, and then what we do is we actually start to spend coming out of it. So that's where you see major infrastructure spending. That's where you see, new build developments coming. You see all these sort of, government programs to spend. And interestingly, we've already started to see those. But, to be fair, we're already in recovery. Yeah. Now, a lot of people say, no, that's not a recovery. It's a dead cat bounce. We're still going to drop and we've got 40%. It's going to be so you're always going to have that in your ear. Yeah. But actually, if you look at the fundamentals, even something like as simple as 100 billion saved, over that COVID period, that's a huge amount of money, that potentially going back into the economy. Yeah. Now, sure, some people will save it. But a lot of that will go back into spending. That can see us come out of that, So I guess, look, we'll see. And I think, guys, I haven't had any comments this chat. So I'm just, if you're there, just sort of say yes, because I'm just a bit concerned that maybe the comments aren't working. Or is there nobody there? There's people there, definitely. So yeah, come out. But guys, if I'm talking above you too, and you've got simple questions, just ask me a question. I'm happy to go, and break it down to its simplest terms. Any of these concepts. But I think the real thing across all this, before we move on, is this: there's some big money being spent, and this is the social experiment that we're seeing right now, which is basically that normally what we do is we try and restrict government spending. We try and drop the spending, and raise taxes and things like that. But this time what they've done is they've actually just tried to stimulate and spend and spend and spend. And they've had to. I mean, they were forced into it whether they liked it or not. Yeah. But the outcome potentially could be that we see us through this recession and actually that things work out pretty damn well. Yeah. So, we'll see how that goes. But look, guys, I think with that side, there's so many things we can talk about this debt tsunami. And I think the emerging countries are really the ones at massive risk in this. Yeah. We can go after the advanced economies and say, their debt to GDPs and all this sort of stuff is way too much, getting too high. But in actual fact, I think with the borrowing getting cheaper and looking like it's going to stay cheaper, that will allow governments to continue stimulating. And let's face it, all the reserve banks and that around the world, the Fed, all these sort of guys, they have pretty much committed to, printing more money. Yeah. The government's committed to stimulating the economy. And whether that be through a top-down American approach where they give it to all the rich people and maybe they'll decide to trickle it down, or whether that be the furlough scheme, which gets basically at the base level and goes to each individuals. I mean, never before have I seen in a recession people save 100 billion pounds. Yeah. But that, for me, is massive testament to not trickle down, but actually injecting the stimulus where it is needed. Yeah. And my gut feel, is that above all else is going to see us come through, really well, and I think that's, it's going to be great. But there is always the risk, so it's not 100% guaranteed or anything like that. But I have to say, I'm constantly impressed. I sort of go, well, actually, October things will slow down now. November things will slow down. December things will slow down. No, they can't go in January as well. Things have to slow down. I mean, look, to be fair, most markets close down over Christmas and that sort of stuff. But, I was chatting to the delivery guy the other day. He's as busy as ever. He's never had so many, and I think that's obviously Christmas, but that's also a function of people are at home, people are ordering, So, yeah. So, let's move on. Winners and losers. Look, there's new types of credit. And I think this is credit management. Sorry, not new types of credit, but credit management. And I think this is really important. I think there'll be new processes than that. What generally happens when there's debt, okay, and this talks about Australia, that had natural disasters, lenders created new process for collections, yeah, rather than just writing off loans. If you look at how things normally work, yeah, a small percentage of those loans, which you normally build into the cost, get written off. And say, for instance, if you're a big company, like let's say credit card company, Amex, Amex will have people that they're in arrears. So they don't pay their bill and they don't pay for 30 days and then they don't pay for 60 days. And Amex, and I'm not saying Amex, sorry, but companies like that will have a cutoff point at which time they go, you know what, or an amount where they go, you know what, sell that debt off. We've tried to chase it, just sell it off. And they'll sell it off for 50 cents in the dollar, you know. And when they sell it off for 50 cents in the dollar, that then they don't chase it anymore. They close that account and they leave it to the debt company they sold it to. Yeah. And then that company goes after it for a while and then they'll sell it on. And then, you know, and vice versa, that's the thing. And I think what you're going to see now, and I agree with this comment, that you're going to start to see more innovative ways to get that money back. Whether that be more flexibility in payments, whether that be linking it and, you know, pulling it off your wage, a whole range of things. So the problem is the winners through the recession won't have this issue. The losers through this recession, it could be a long tail recession for them. So I think the key here is if you're in a situation where you're potentially losing your job and that sort of stuff, hopefully you've been listening over the last few years and you've got yourself in your portfolio in a position where it's not going to affect you. Yeah, but if it is, the best thing you can do is, even before you get into the problems, start sorting things out now. Start paying debt down. Yeah, because that's good. And I'm not saying necessarily investment debt, but I'm saying consumer debt definitely. And don't take on more debt, because potentially 2021 is where your unemployment rate, and next week we'll be talking about the unemployment figures are released on the 15th. So we'll have the new unemployment, we'll have the new redundancies and things like that figures. And so we'll have a better idea of where we're at. Yeah. So guys, I still haven't had any comments. So I'm a little bit concerned, but anyway, yeah. Look, guys, so for those of you who, look, if you've been listening to me for a while, you'll know that I love London, you know, Birmingham, Manchester, you know, Liverpool, and those places are sort of my main focuses for investment, because that's where stuff's happening. Yeah. So I just thought I'd show you. And if you're looking at investing, you know, for me, major cities are the way to go. And, you know, getting close into those major cities is a great place, because that's where the fundamentals are. That's where they bounce back the quickest, you know. And so what we've got now is, you know, Copperworks in Birmingham. You know, Birmingham's a world city now, you know, pretty much undisputed. I mean, I don't think too many people, you know, it's #1 for startups outside of London. You know, phase 1 HS2, that's the high-speed rail that's being built right now, you know, from Euston. You know, you've got major employers who've moved their head offices there: PwC, HSBC, Deutsche Bank, BT, Lloyds. You know, you've got this particular developments in the Jewellery Quarter, which, you know, if you go to the Jewellery Quarter, is actually in the north west of the country. You can see the little red dot there, you know, just outside the city centre. You know, we're talking 5-7 minutes, you know, drive, if that. You know, prices from 185. So when you're looking at, you know, London, you know, it's a significant step down. Even from Manchester, it's a step down. Yeah, completions in, you know, Q1 2022. You know, so you've got that time. If you want to, you know, find out more, have a chat to the team, and, you know, you can, you know, they can go through a cash flow. They can take you through all the details about Birmingham, about the area, about the strategy around this, everything. You know, or you can log into the website at my.easytrack.uk/the Copperworks Birmingham. But yeah, guys. So look, any questions? We haven't had any questions this today. It's out of the ordinary, so I'm not sure what's going on. I hope that the comments are working, but yeah. Anyway, obviously I've either totally bamboozled you with all the economics in this one, or you're in total agree with me. We'll see how the comments come out after we, you know, once we publish this. Oftentimes, you know, once we publish it on YouTube, I mean, obviously it's live now, and also Facebook, you know, we get a few comments coming through. But look, guys, you know, anything you need, you know, you can email me at webinars@gladfish.com, and, you know, I'm happy to answer with videos. I'm happy to, you know, run through anything, you know, that sort of stuff. Subscribe, you know, like, and, you know, yeah, any questions about anything about to do property. If you want to learn the principles of building a portfolio, chat to the team, gladfish.com. Otherwise, if there's no questions, I'll say thank you very much, and we'll see you again next week for my final one. Then I'm having a couple of weeks holidays, and yeah, Merry Christmas, and hope you're all ready and you've got all your presents, because apparently it's quite busy for the deliveries now. So if you haven't got them, you might miss them. All right, guys, have a fantastic week, and we'll see you next Wednesday, same time. Bye.